Most of the decline in these great bear markets only happens after the first interest rate cut. So you tell me when the first interest rate cut is, and I will tell you when the second half of the pain is going to start. And it would be unlikely from a historical point of view that this financial and stock market event would not run deep into next year. And that's what it looks like. It's not hurrying. But let me bring up another point on your chart. We have forgotten to inflation adjust because we haven't had inflation for 20 years. In the old days, all data like this, everything you read in The Economist, etc., was always inflation adjusted. We have had, for example, over 10% inflation. The market isn't down 15%. The market is down 25%. In the housing bubble, there was no inflation. In 2000, there was no inflation. You can't compare this one with 10% inflation with that one that had a couple. And 25% is a pretty decent down payment on this bear market, I would say. The passage of time against a market that has a trend line and in an economy that has inflation, the passage of time is pretty painful. If you even stay flat, you are losing money at a decent speed. And people have forgotten that. People make a big mistake to average bull markets and bear markets. But this is not about that. This is about something quite singular and different that happens on rare occasions in the great bubbles. The 2.5 sigma ultimate euphoria episodes. It's like a phase change. People go from fairly sensible behavior in an ordinary bull market to absolutely crazy as could be in these great bubbles. When you come down from a high, the ultimate sugar high of a super bubble, almost infinite optimism, a belief that good things will go on forever, that record profit margins, et cetera, et cetera. And the bubbles always form at the end of a long, heroic economy and everything in the garden is perfect. And it always has taken cooperation on the part of the Fed and the administration. So everything is perfect. And then when something pricks that confidence and it begins to leak out, there is a long way down to go from the peak of optimism to at least mild panic, if not severe panic. It's a long drop. You're never going to be able to predict which brick goes first. In fact, you should expect the unexpected. And each time it seemed to be unexpected. Who imagined Bear Stearns would go, hey, the bear, as we used to call them, they were the guys that always inflicted the nasty paper on other people. And when the music stopped, they always had one of the chairs. Silicon Valley, until you think about it and look at the balance sheet, it did appear to strike the world as a complete surprise. And maybe that is my point from 60,000 feet, that is the nature of the beast. You should expect that the first thing that goes will, generally speaking, be a surprise. And then how it cascades is virtually unknowable. But let it be said, after the handful of the great bubbles, there has always been a recession. If people behave well, the leaders are sensible, it's a mild recession. 2000 was about as mild as it comes. If they behave very badly and get unlucky, like 1929, you get a depression. If they behave badly and refuse to regulate subprime instruments in the housing bubble, they brought the system to its knees on the mistaken belief that capitalism could self-regulate. And what a horror show it was. Somehow, that capitalism is responsible enough to regulate itself. Well, it just ain't so. And capitalism needs a policeman at the corner of Broad Wall, as FDR said. And in recent times, some of the policemen have been taking time off or being regulated off their beat. And then you get into the third phase, and that is the fundamentals. And that's the difficult one. How long and how painful will the actual reality, the adjustment phase be? How badly will the economy slow down? How badly will profit margins shrink? So we're going to have an unknowable bad time. It will depend on how effective the administration is and so on. But the truth is, we come into this with very high profit margins. We come into it with a form of capitalism that was raising prices for the first time ahead of the workers, so that in unexpected inflation, very quickly profit margins went up and real wages went down. This is not what happened in the 70s, I can assure you. Profit margins went down and real wages went up. But this is a corporate system that we could talk about, which is really quite interesting. The American corporate system has developed a style that makes it almost possible to break the law legally. And what we have today, increasingly now for 20 years, is a style of capitalism where the stockholders are leaning on the corporations to take it easy on CapEx. Why? I mean, basically, it generates an economy of mild shortage all the time. You want to make money, that is the world to live in. So mild shortage all the time, pressure on the workers. In the good old days, they always built an extra plant. It was the bane of stock analysts like me in the 60s and 70s. Whenever things started to improve, 8 paper companies would all start to build a giant plant at the same time, and they would crash the prices. It was great for jobs, great for GDP growth, pretty good for productivity, terrible for stockholders. And now we don't. The CapEx has dropped as a fraction of the total pretty steadily for 20 years. The degree of concentration, or monopoly if you prefer, has risen pretty steadily for 20 years. And it's all legal because it's the stockholders breathing down your neck saying, dudes, buy your stock back. Don't build a risky new plant. It might work well. It might be mistimed. In any case, it's risky. Better to wait and see which of the hundreds of VC firms work out well and then grab 1 or 2 of the best ones. It's a capital transaction, doesn't go into the income statement. All that dangerous volatility that you used to have associated with your own endeavors, you can now smooth out and wait to see who wins. So the profit margins have risen steadily. And even in adversity, they are good. Even in COVID, they're good. Even as the economy slows down, even as inflation unexpectedly bursts on the scene, you suddenly find yourself, oh, what a surprise, in a world of mild shortage. Any surprise, and we are short capacity. And this is wonderful for profits, terrible for the economy, terrible for equality and the wage rates of the workers. The stockholders bullying management into doing what management always wants to do anyway, which is live in a world where you control everything, you buy your own stock back. And Warren Buffett has said some very interesting things about stock buybacks recently. Like anyone who suggests there's any damage done as an enumerator or a villain. Of course, he did say all buybacks. Anyone who says all buybacks are damaging. Of course, that word all can be used to make. There's always some exception. There's always some part of anything that is useful. You don't want to do any CapEx. You want to live in a world of shortage. So you just buy your stock back instead of building a new plant. And if you think that that does not remorselessly push up the price of stocks, you are not exactly innumerate, but unimaginative. Of course it does. Secondly, it was illegal for the first 15 years of my career and forever before that, since FDR, because they argued that the insiders in the company knew everything. And going out into the market and buying from the uninformed was stock manipulation. How ridiculous. How ridiculous to think that the corporate insiders know more than you do as an institution buying from the outside. Of course they know more. Of course it is facilitating stock manipulation. And in my opinion, of course it should be illegal. People say, well, it's the same as dividends. Well, in that case, whoopee, pay a dividend. And nothing has changed. You pay out a dividend, I'm happy, and apparently you're happy. And Warren will have to pay some taxes. I'm sorry about that.